Hello and welcome to another Wealth of Advice market update, which I'm recording on Friday the 24th of June. I'm just back from my summer holidays. I've been across to America for a couple of weeks in sunny Florida. My colleague Matthew Sinclair has recorded the bulk of this market update over the last few days. Him and Jordan, who heads up our investment research team, have been speaking with lots of fund managers. They're going to give you more information on that. There's going to be a second link for another video where Mike and Matthew were talking about concerns that have come from clients, questions that have been raised over the last few weeks, a conversational piece we're calling it, which hopefully some of you will find of interest. So first up, here's Matthew with an explanation of what's been going on in world and market news.
In market news, we've seen Boris Johnson survive a vote of no confidence. As we've said in the past, markets don't like uncertainty, and political uncertainty counts for that. So there's definitely a question mark on what that means for the government and what that looks like in the future. We've also seen politically this tension over the Northern Ireland Protocol with the EU and the UK. So it'll be interesting to see how that plays out. We've also seen a £5 billion windfall tax announced for UK energy companies. That'll help fund £400 discounts on October's household energy bills. And I think, one of the key topics we're going to talk about today is inflation and how the energy prices have impacted that. When we look at inflation figures, the UK CPI figure is currently about 9.1%, and the Bank of England predict that it could surpass 11% sometime this year. And again, when we look at other things that we'll cover in this update, that's why they've made a real commitment with interest rates, both in the UK and US, to rise them to try and get on top of inflation and tackle that problem. When we look at US inflation, it's currently 8.6%, and that's the highest it's been since 1981. So that helps put that into perspective of how high inflation is. In the US, there's a prediction that US GDP, so that's gross domestic product, that'll grow by 3.1% in 2022. And when they're looking forward, they've sort of pulled down their estimates. It's 2.2% for the year after in 23 and 1.5% in 2024. So that helps put into context some of the market consideration of what the next few years look like. When we think about Chinese COVID, lockdowns are hopefully going to end, which will ease supply chain constraints, and we're hoping to see that flow through into output across the globe. In other news recently, the state pension triple lock to be reinstated, so state pensioners could get a benefit from that next year, which is expected to be potentially 10% in line with current inflation. We just mentioned US GDP there, so it's interesting to also look at the UK side of things. UK GDP contracted by 0.3% in April as we've seen the economy slow. And again, the first chart here demonstrates the trends of quarterly UK GDP. You can see the impact COVID had there, and then the impact of coming out of COVID, and now the uncertain times that we've got at present. Q1 2022, growth was about 2.5%, and it should be expected for this to slow as there's still above long-term trend of around 1% once the economy comes out of COVID. An interesting part of looking at the monthly change is to look at the UK GDP. And when we were looking at these figures, we saw that actually it was the health sector contracted. And when we looked at why this was, that was because the NHS track and trace programme finished in April. So that reduced that sector by about 7.6%. So it's interesting to see how these things are made up. Interest rates have definitely been at the fore of the news recently. The Bank of England raised interest rates to 1.25%. And the European Central Bank announced their first interest rate rise of 0.25%. And that was the first rate rise in over a decade to help put that into perspective. The ECB, the European Central Bank, has a challenging position. They're trying to control inflation, but they're also trying to protect some of the weaker economies like Italy and Greece, who will be hardest hit by the impact of the rate rises. In the US, again, we've seen a big rate rise. We've seen that go up by 0.75% to 1.75% this week. And at the start of the year, US interest rates were predicted to reach around 2%. Rates are now estimated to end closer than 3.4% because inflation is really this key topic that they're trying to get on top of and trying to tackle. And when we've been catching up with fund managers over the last couple of weeks, inflation's been a key topic that we've been talking about for them and how their portfolios are positioned to ride through both inflation and also the impacts of things like interest rates changing. So that brings me on nicely to one of the calls we've had this week. Jordan and myself heard from Janus Henderson, who have got a strategic bond fund that we have in some of our portfolios. When we were talking to them, it was inflation that was one of the key areas we talked about, and that interest rate to try and impact that. So when we talked to them, they felt that the US government were really focused on core PCE consumer inflation. And then just to try and put that into context, that's a slightly different inflation target that they usually look at. But I think that's because they were seeing inflation as becoming a bigger problem. So they were really saying, this is our primary objective that we're looking to fix. US core PCE peaked at 5.4% in February, and it's now dipped to 4.9%. So there's a sign there that they could be starting to, win the battle against inflation. But one interesting thing that we've looked at is actually what percentage of that inflation is made up of things like the impact from COVID and the impact from the energy shock as a result of Russia, Ukraine, and other factors like supply chain. So when we look at a headline figure of US CPI inflation of being 8.6%, 5.5% of that CPI is made up of COVID impacts and the energy shock from Russia, Ukraine. So I think these are areas where the central bank haven't got control. They haven't got an ability to impact that with interest rates. So it's just the bit on top of that they're really trying to curb down to try and get on top of inflation, and the hope that that 5.5% that we've talked about there comes out of the system naturally as we move towards a progression with the conflict and COVID supply chains becomes a thing of the past. Looking specifically at bond markets, I think there's still a view that inflation and interest rates are going to have an impact in this space. So again, when we were talking to Janus Henderson, they had the analogy of their fund management team having a strong hand at the wheel. They're trying to actively position their portfolios to be defensive and take into account both the inflation element and the potential interest rate rises to help navigate your funds through these choppy periods. Over the last couple of weeks, we've had a lot of updates with fund managers. Again, during volatile times, we like to hear what they're doing to add value to your portfolios. So as well as Janus Henderson, we've also heard from T. Rowe Price, HSBC, Legal & General and Royal London. Again, we're pulling all this information in together to help look at our investment process, look at your portfolios and to see if there's anything we need to change within portfolios. Again, for yourselves, it's a long-term approach. So this is why we are looking at your attitude to investment risk and looking at that asset allocation for yourselves. Jordan and Chris spoke to Julian Cook recently from T. Rowe Price. They've got a US focus, and he was really giving us an update on the US Large Cap Growth Fund, which again makes up some of our portfolios. Chris asked Julian a few questions, and we've got a clip to show to you here.
Commentators or certain journalists I've read wrote about what's happening at the moment have suggested that what we're seeing now is similar to the dot-com bubble, if you like, where stocks were massively overpriced as we came out of COVID, and then there was obviously that big bust in 1999 into 2000. But when I read that, I'm confused in the sense of the problem with the dot-com bubble was no companies had any cash flows who were massively valued. They hadn't even made any profit, lots of them. But companies right now, as I say, your Googles, Amazons, Apple, all these, Microsoft, Disney, all these share prices are down across in the US, but they're making tons of profit still and having good cash flows. So is it the same as the dot-com bubble, or is it just a lazy journalist way of describing it, do you think?
Yeah, Chris, I think you've answered the question. I mean, the largest companies in the US have the strongest balance sheets on the planet. I mean, it sounds a bit sort of like a verbose thing to say, but these companies have like the best balance sheets in the world. So if you think, what do you need when you go into a recession? I guess if you were to enter a recession, what do you need? You need a strong balance sheet and you need free cash flow. If you have those two, then you can do really, really well through a recession. You survive. You come out the other side. In the dot-com environment, it was all about sort of measuring sort of eyeballs as opposed to actual real sort of free cash flows and balance sheet strength. These companies don't need to raise capital because of the strength of their balance sheet and because of the strength of their free cash flow. So it's completely different in terms of the backdrop to these businesses that we saw back in 2000.
You mentioned the R word, recession. In the UK, we believe that a recession, we might be actually in it now when the data comes out, 2 negative quarters. brings a recession, and there's obviously a fear that the Bank of England was going to raise rates too quickly in the UK, which would bring on the recession. I mean, across in America, is a recession likely? Is it due now? I mean, what's your general view on recession over there?
Well, I'd certainly say that the stock market is suggesting we're in a recession. You've seen this huge pullback in the markets, particularly in the growth side. So I'd kind of suggest, well, maybe the market is already discounting some degree of recession in here already. It's not as if we're talking about markets at all-time highs and then the word recession gets mentioned. We're talking about recession, and it's been talked about, I guess, since the start of the year, and markets have actually readjusted, pretty aggressively down to the downside. So I guess in the US, you could technically say we're actually in recession if you believe some of the numbers that are out there. But I think the markets are definitely suggesting, more of a recession is I guess in prospect than not at these levels.
One really interesting thing to look at is, well, when we think about investments, how are these companies valued and what are fund managers doing to try and add value for your portfolios? There's lots of different options that people can invest in. This graph here compares Zoom, the value of the company Zoom, which is the blue graph, and the value of ExxonMobil, which is the fourth largest exporter of oil in the world. And I think the amazing thing here is that you can see on this graph that there's a crossover point during the pandemic when the company Zoom was worth more than the fourth largest producer of oil. And again, with the supply chain, with the energy prices that we've seen, you can see how coming out of COVID, how those prices have changed. And part of what fund managers doing for yourselves are trying to look at long-term trends, trying to predict where they can add value. And this is where they will be chopping and changing between companies like this to really try and get you those returns over the long term.
So we now come to the part of the presentation where we talk about investment performance and how the various funds portfolios that we recommend have performed, as well as how different markets have performed over various periods. The first chart that you can see there is how the various indices around the world have performed year to date. This time we've put a few more stock markets on, so you can just see the sheer volatility of what's going on, the ups and downs, and how severe some of those have been. As I say, the one at the bottom, the red line, is the NASDAQ, which is the US stock market that invests purely in their technology companies. And as you can see, that's down 24.47 year to date. The MSCI Europe, obviously that's affected massively by what goes on in Ukraine and Russia. That's down 16% year to date. The FTSE 100, which is the UK flagship index, we all see advertised its performance on the news every evening. That's down 3% year to date. If you take out the oil companies in the FTSE 100, that blue line would be close down to where I think somewhere between B and C, because it's oil companies like BP and Shell have kept that one as high as it is, albeit it's still negative. So the first 6 months of this year really have been the worst 6-month period that we've seen in stock markets for a long time. If you go back to COVID of 2020, the COVID crash, that really started middle of February, hit its low point by the end of March, and clients were back in profit by sort of June, July of that year into August maybe. Whereas what we're seeing here, it's 6 months of progressive ups and downs, and negatives along the way. As ever, we would say if you have any reason to get in touch, please give us a call. We understand markets are volatile at the moment and the news that you're seeing isn't really positive. Last night, obviously, the Conservatives lost 2 seats in the by-elections. We'll see how that affects political things over the next few days. Markets are up this morning. I'm not sure if it's on the back of that, but it's just the world we're in at the moment. One day positive, one day negative. We need to just keep a good focus on what's going on, and just remember that all of our clients who come to us are investing for the long term, and we do believe our long-term strategies are sound. So thanks for listening, and we'll be in touch again soon.